Now let's talk about business, which is main thing I want to spend time. Who have not heard about the 20% deduction for business? Do we have in the room people who have not? Okay. Well, I forgot in this room you don't raise hands. Okay, okay, opposite. It's okay. If you did not hear, if you never heard about 20% deduction, just emit some kind of sound like. Okay, that's fine. You can keep your hands down and finish part. This is what happens with 20%. Everybody, remember Oprah, right? Our next president, Oprah, right? And everybody gets a car, right? So here, everybody gets 20% deduction, right? Everybody, that's pretty much what that provision is. Everybody who is in business. So what happens is this is how it works, but people don't understand the concept of how it works. So you're a wholesaler, and you collected during this year, the 18, you will make 100 grand in assignment fees as a wholesaler. So what is your deduction under this new rule? Anybody? 20,000. Wrong. Okay, that's where misunderstanding starts. Yes, it's 20%, but it's 20% of net income. Net business income, meaning after expenses. So if you're a wholesaler and you made 100 this year, you subtract from that your business expenses, which are marketing, driving, everything else that you spend. You know, of course, hiring a great accountant, like all of that, right? So you reduce that 100, and right now it may be 40 left after your expenses, depending on your level of expenses. Now, if you also bought a useless 100,000 coaching program, then your income is zero, right? How much is your deduction from there? 20% of zero. If you have a calculator, check, 20% of zero is, okay, somewhere around zero. So let's quickly understand again what is happening. We have 100% income, we subtract all deductions. Whatever is left is subject to 20%. So let's be very clear about that. Next is who it applies to. So who qualifies for that? Sole proprietors are passed through. Let's stop on that and talk about. When we read that 20% applies to pass through, currently under today's rule, what are pass through things? Entities. They are LLCs, S corporations, partnerships. I'm not being exactly proper tax-wise, even though I'm a licensed person. LLC in itself does not have tax determination. It's the correct way to say it's LLCs that are taxed as partnerships or as corporations. Those are pass-through entities. Those that file separate tax return in the past. Never before sole proprietors were treated the same way. So we had separate rules for pass-through entities, as corporations and partnerships. But sole proprietor was treated differently. Sole proprietor means no entity. You did not create a DBA, which is, you created something like a DBA, which is not an entity, or did not create anything. Okay? Then you are a sole proprietor. Also, if you have a single person LLC or husband-wife LLC, we normally treat them as what is known as disregarded entity. Now, surprisingly, it's very rare in the world of the IRS when we say something and it actually means the same that you hear. It's a disregarded entity. In this case, it's actually exactly what you hear. He does not care. He disregards that. Meaning is, you have an LLC which is treated as sole proprietorship. But tax treatment of those was different. Under the current rule, it's pretty clear that sole proprietorships are treated the same as pass-through. Meaning is, you do get 20% deduction. So whether it's inside a corp, inside partnership, or not inside anything, just directly on your personal return. Remember which schedules? Do you remember we started A, B, C, D, E? And this is where it gets a little interesting. A is for deductions, it does not apply. B is an interest. If your income goes on Schedule B, do you get a 20% deduction? No, Schedule B is for interest. Interest is not considered business income. You don't get it there. Schedule C, that is business schedule, yes. If it's on Schedule C, you do get 20%. D D are capital gains, they are not considered investments. You do not get 20% on that. E is where rental properties are. That's where it gets interesting, I will return to that. But basically, A, no, B, no, C, yes, D, no, E, maybe. We'll return to E. E is the most interesting part here. Okay. Which is the next point is, okay, most passive investors eligible for 20%. We say most. This is, remember when I talked about how nobody knows what is going to happen? How everybody makes conclusions, renders opinions, but everybody at the higher level of knowledge, like where my peers and I consider myself there, is okay. We look at it and I'm saying is, well, we can guess, but we don't have exact answer. Because the law does not spell it out clearly. It refers to interesting thing. The 20% deduction applies to trade or business. Income from trade or business. Here is the thing about trade or business. Trade or business existed in the tax law for about 30 years. Never in 30 years it was defined. How do you like our tax law? Like it's based on the term trade or business, but it never defines that. So when we look at it and think, what exactly is trade or business? Can you give me a definition? Like, okay, if I have a rental property right now, am I in trade or business? Okay, if I have 5, am I? If I have 10, if I have a K1, if I'm a wholesaler, if I'm so it starts like going through all of this stuff, and where what it's based on is not the law, because there is no formal definition. It's actually based on interpretations. Who likes the word interpretation? No. Okay, who has teenagers? Okay. Who used to be a teenager? Okay, so then you should understand what the word interpretation means. Like, yeah, there are rules, mom and dad have rules, but teenagers have interpretations. So that's how the tax law is based. We have trade or business qualifies and we all interpret. He interprets that one way, okay? We want to interpret it a different way. Okay, Facebook interprets it, any way they please, that's what Facebook was designed for. They're then whining about your personal problems, essentially, two things, So, when we go there is we need to say, so what constitutes a trade or business? And this is what, again, nobody knows for sure, but we have some guidelines. Based on history, based on what courts used to say, and based on what we believe congressional intent was, and how it's going to be clarified. We believe that it should raise, and I'm going to throw a technical term at you, which unless you're an accountant, you wouldn't know what it means, but I'm going to clarify it in a minute, the practical meaning. We believe that what they actually meant is traded business in the sense of section 162 of the tax code. Now, I'm noting, nowhere in that law it refers to section 162. We just imply, we think that's what they meant. Until they clarify the law, issue regulations, and we say, oh, regulations clarification. When is it going to come? Here is a clue. Do you know when Obamacare came? Do you remember?
2 years later.
How many years ago? Okay, how many years ago Obamacare?
8.
Okay, not quite 8, it's okay, 7. Okay, 7 years ago it came, okay? 7 years later, we don't have those clarifications yet. They promised to issue official final regulations, they're still not created 7 years later. So okay, here it kind of gives you a clue. So when am I going to have clarifications on that? 7 years from now, maybe? But realistically, is tax professionals believe that we will not have it until in 19, when it's time to start preparing tax returns. Hopefully, by that time we will have more clarity, but maybe not. So we are going to all be in a gray area for a while. So what we believe that implication of section 162 trade or business is, we believe that you have to be quote unquote actively involved. Again, so if I say actively involved, what that means, nobody can tell you for sure. But the easier way to explain that is what we believe will not qualify as that. This is examples of what we believe will not qualify. If you have W2 jobs, you and your spouse, and you have one rental property on the side, like just on autopilot, There is a house, you have a tenant there, tenant sends you check every month, you send check to the mortgage company every month, that's pretty much it. We don't believe that will qualify. Okay. If you have 5 properties and you use Jerry time, his company, to manage those properties for you, and your involvement is to get a report from Jerry once a month, then you probably will not qualify for that. If you invested in partnership that owns apartment complex, and your involvement includes periodically looking at that report and hoping that you will make huge money when they refinance, you probably will not qualify for the 20% deduction. That actually gets more interesting, because when you invest in partnership, that 20% has to be determined at partnership level, not at your level. You will not even have a freedom to decide. They will tell you if you qualify, and they will probably tell you not. Okay, so what is the recipe for those of us who just have passive income from rental properties? Increase your involvement and document it. That's my advice. Do more. So, what does it mean, do more? Okay, maybe you should be the one actually interviewing the prospective tenant. Maybe you should sign that lease agreement instead of your agent. You actually personally be there and sign that agreement. Okay? Maybe you should visit that property once in a while and check what is going on and document what you are doing. Okay? The more involvement you have, the more chances you have as a passive investor to qualify. But before all of you, and I see like gloomy faces saying this, oh crap, I thought like passive was I'm never going to visit a property. That's what is passive. Okay. Remember how 20% is calculated. On what is it calculated? On net income. What is net income for most passive investors? Negative. Right? You have rent and then you deduct all of your expenses